Are we going to start this?
You usually start the podcast, Dan.
Well, yeah, but here it just says, let Dan come up with the intro.
Okay, so did you?
Nope. So what are we talking about today?
All right, let's talk about unwinding poor financial products, open enrollment, and the timing of Roth conversions.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. I feel like you're setting me up for a really fun thing to start with, and then maybe some more practical, technical stuff on the back end here.
I think that's accurate. I want to start with unwinding poor financial products, right? So, we sometimes work with some folks and they come to us. We review their data and information, and we find a product or an investment that is just a red flag, right? This thing is not suitable and we don't love it. And sometimes these are products, sometimes these are just investments, sometimes they're easy to get out of, and sometimes they're really cumbersome to unwind. That being said, first and foremost, when we're reviewing a client's data, what's the first thing that kind of, sticks out when we're looking at something that indicates it's maybe not a great product?
There's certain obvious red flags, and there's some regulatory guidance around here where you have to be careful to not just say, like, a product is bad. If it was just ubiquitously bad, then regulators wouldn't permit it. So there's a little bit of nuance to this, but typically we're looking for things like Class A or Class C mutual funds. We're looking for, insurance products that are managing risks that the client doesn't really have. Or we're looking for, really complex financial instruments in a use case where there's just not really any need for that type of alternative, risk-reward profile.
Okay. Do you think there are just objectively bad products out there, or do you think it tends to be a misalignment of what's appropriate for the client and what the product actually provides them?
I personally think there are some products out there that just don't make any sense in today's world. And largely this comes back to sort of a distinction between investment advisors and brokers. But there are a lot of commission products that exist where the argument for them is essentially a niche case in which somebody could not afford professional advice without the commission product being available to compensate the broker for giving them the advice. But in real dollar terms, the commission they might earn from recommending the product is so small that I just don't think that argument holds much water. So you're talking about something like, here's a product that has a 5.75% upfront sales charge and it has a minimum investment of $50. So if the advisor puts them into it, they will get paid like $2 to $3, and that's going to pay them, quote unquote, reasonably through a commission for their services. And the investor gets to invest their $50 minus the upfront commission. And that just doesn't really hold water with me. Like when the numbers are so small or so de minimis, I find myself of the opinion of like, look, there just has to be sort of like a pro bono line where you just say like, hey, if we're talking about saving your first $50 and you have no other money with which to afford this, just give them the advice for free. Just recommend that low cost index fund, target date fund, whatever it is. I just don't see a great use for these products that have, again, this very like specific and kind of weird, commission justification for existing, because it results in the purchase of what is often otherwise sort of a subpar, overly expensive financial product. And in turn, it's not like the broker is making a living, $2 or $3 at a time.
I hear what you're saying in that, right? It's not even really enough sometimes for the broker to justify what they're charging or what they're going to make on it because it's so minimal. But I assume there are times in which they're also selling products and investments that they do make, a pretty nice commission on. And these products may also be, let's just say, lackluster, whether it's mutual funds or, maybe some annuities or life insurance. Can you speak maybe to your experience with some of these products that we don't love?
Sure. Annuities are a good case where I look at them and I say, there's no such thing as like just a universally bad annuity. I think there's a type of annuity, whether it's fixed a SPIA, a fixed indexed, a variable. There's all these forms of it where it's just about the application of the right type of annuity to the right client for the right risk management that they're trying to obtain. And that's really the key thing here is annuities are insurance products. They are a risk management tool. Their fundamental purpose is to help avoid the risk of superannuation, which is the risk of running out of money in retirement. Like that's the textbook purpose of an annuity. And so, the big problem that you see is things like income-based annuities being sold to young people, or, these aggressive variable annuities with tons of like retirement benefit riders being sold to very young people, where the cost of all the fees and riders is so great that they're not going to really accumulate wealth. So the benefits are not going to be that great anyway. So it's not to say that like annuities universally are bad. It's that often the thing we're looking for here is, I see this person, they're 30 years old, and I go, why do you have an annuity? Or this person is 60 years old. I say, why do you have that kind of annuity? So it just becomes a question of like mismatched fits.
I think that's a good point. I think we hear a lot of the time that X product is a bad product, right? And it's terrible for everybody. The reality is, a lot of these products are adequate when used for the right, it's used in the right fit for the right person, really. But what we just see too often is someone trying to put a square peg into a circle hole, and that's just not going to work for the client. And it gives the product a bad rep. I think we see this a lot with insurance too, right? Whether it's just like whole or universal life, right?
Oh, I mean, all the time. I would argue probably the average American household does not have nearly enough life insurance. And of those that do have life insurance, too many of them have the wrong type of life insurance. That means that they simultaneously have life insurance and also don't have enough. The big challenge that you see is that permanent policies will cost something like 10 to 20 times their term equivalent. And so you'll see this world where somebody will have like a $250,000 whole life policy and no term coverage. And when you run their needs analysis, they need $1 million, $2 million, $3 million to provide for their spouse or provide for their family, their kids. And you look at it and go shopping for it and find like, wow, we could get you $2-3 million in coverage for a term policy for 20 years or 30 years, and it would cost less than this only $250,000 of permanent policy. The strange thing is, and maybe this product exists and I just haven't encountered it, to me it is kind of odd that there is not just like a universal term policy that is just until 65. Call it like a version of a permanent policy, except it just expires at 65. Because for the vast majority of people who are obtaining life insurance, the primary use case is I have an income, my spouse does or doesn't have an income, I have kids, whatever it is, right? And I'm trying to protect my spouse and or my children from the loss of my income due to my untimely death. Like that's the primary use case for life insurance. There's a whole bunch of advanced fringe cases. Advanced, irrevocable life insurance trust things, estate planning reasons, charitable gifting strategies, pension maximization strategies. It's a whole bunch of like special niche cases for permanent life insurance and other types of life insurance. But the core use case is protect my family from my death during my working years. And yet, the big red flag is you'll see tons of people with remarkably inadequate amounts of permanent insurance, right? And then essentially no term insurance or a nominal amount of term insurance that they could have afforded a lot more of, which would then provide them with greater protection from the primary risk that we're talking about, which is, again, death and the inability to provide for your family.
Yeah, it's actually interesting now that you mention it. It's not a product I've seen either, but it would be a pretty easy sell. I mean, I'm not an actuary. I don't know how to run the numbers from an insurance perspective, but it seems pretty practical having a policy to 65. So these insurance and annuity products specifically, Dan, right? We see them with a lot of folks who come to us. And to put it nicely, they are a pain to get out of, right? Either we haven't broken even on the cash value for some of the life insurance policies, or the annuity isn't serving the purpose we think it is, but it's difficult to, call the right people and get out of it. Can you just talk a little bit about maybe some of the times in which we see a client that comes to us, they have one of these lackluster products, and maybe we keep it because the juice isn't worth the squeeze to, get rid of it or take all the time to, get out of it? Can we talk about that a little bit?
Yeah, sure. I mean, a really common case we see, particularly for our clients like in their 50s and 60s, is going to be like a married couple that got sold a whole life policy in like 1992. And it's got like a $50,000 death benefit and it costs like $20 a month. And we're sort of at a point here where it's like, okay, I mean, we could potentially 1035 this into an annuity as a buffer for retirement income. It's also costing you, less than like 2 lattes at Starbucks, so at some point I kind of go like, I don't know that it costs us enough to like get too worried about. On the other side of that, I think that's sort of the big thing here is often the Band-Aid rip approach to getting out of insurance, where you're just like, I'm going to surrender my policy, cancel it, take whatever surrender cash value is left from it when I do that, and, take my ball and go home, I think is sometimes a little bit too rash. I think there's often a lot of ways to pivot it. We can take a permanent life insurance policy, turn it into annuity, or convert it into a life insurance policy that has more of a maximized benefit focus on something like long-term care. We can take a high-cost, overly complex annuity and convert it into an investment-only variable annuity with very low fees. So like there's ways to avoid some of the tax hits or the surrender costs that can be involved in dropping a policy. But again, it's something where if you just sort of try to cancel it and back out of it, I think you'll often find that you get punished pretty badly for it, unless you held it for so long that you actually have managed to bypass all the surrender period issues and concerns.
Yeah. What if it's not, a negligible amount relative to the net worth? Is there a scenario in which we will just rip the Band-Aid off and maybe cut our losses before we have to live with this for the rest of our lives?
I think it depends. There's a break-even calculation here, right? Surrender charges can often be on things like annuities, something like 5 to 10% of the amount you invested, which is nuts, right? Like, imagine you bought a annuity 2 months ago, so you're out of the free look period where you can kind of get your money back, and you then talk to somebody else and realize this wasn't a good purchase for you. You could end up losing, $50,000 out of your $500,000 life savings just because. At that point, now we have to look at, okay, what are the ongoing costs? Because the trick is with surrender schedules, typically what they're really doing with surrender penalties is just paying off the commission to the broker. That's sort of the big outlays. Brokers are getting paid these big upfront commissions of 5, 6, 7, 8% upfront on the sale of annuities. Same thing on life insurance. They're usually getting paid a very large percentage, if not more than 100% of the first year's premium for selling the policy. So there's kind of these big front-loaded kind of gotchas in these policies. But at that point, you have to do a break-even analysis. You have to say, okay, let's say I bought an annuity with all things considered, quote-unquote, low fees. Maybe it's 1% a year. Well, okay, it's going to be, let's say, a seven-year surrender schedule where it's going to be 7% the first year, 6% the second year, 5% the next year. If I rip it out now, I'm sort of just breaking even with the ongoing costs of, let's say, getting reinvested somewhere else under a 1% investment management fee under an RIA somewhere. If I'm getting out of my life insurance policy, it's often a much more steep surrender. And part of this is, maybe half of your premiums have been paying for the actual cost of insurance. And then on the cash value side, it may take you, 5 to 10 years before your surrender value really starts to get up to parity with your cash value. But you'll always have lost the amount that was spent on the actual insurance inside of it. So to this extent, right, it just becomes a break even. Back to the annuity example, right, if my costs every year are going to be, let's say, 3 or 4%, so then holding it for 7 years is going to cost me 21 to 28% instead of just kind of breaking even at 1% a year, then I might just need to rip off that Band-Aid. It's going to cost me a lot more to sit in it long term than it is to just go ahead and eat the costs, go elsewhere and try to make up the difference.
All right, so case by case, run the break even and see what it means for your situation here. So let me ask then, me and you both come from fee-based firms, not fee-only firms, meaning that we were licensed to sell some of these products that we're discussing here today. Now that we sit here, both of us in a fee-only compensation model, were there specific products or investments during times with your old firm maybe that you're now, in hindsight, realize maybe weren't the best thing for the client?
I don't think I ever recommended something that was like just truly awful. So that's something I can at least feel good about. I think probably the most obvious example was just sort of a weird coincidence of timing. So when I first got in the industry, I initially affiliated with a firm called Waddell & Reed. And in the same year that I got affiliated with them in 2015, They also had just been awarded Barron's best 10-year performance metrics for a fund family. So of all the funds offered by Waddell & Reed through their Waddell & Reed brand and their Ivy brand, the 10-year returns on average across their whole fund family were the best out of all the fund families. So they were arguably the best investments over the last decade. So it was sort of easy for me in the early days to just recommend those products and go like, well, they just got the best 10-year performance. That's a pretty good metric. And then, of course, like you could expect, they did not stay in the top spot forever. And as that changed, I then kind of pivoted and rotated to other options. And as I got better educated on why they had been there and why they weren't staying there, and kind of shifted my perspective from, good managers can be worth some money to passive indexing is probably going to make a lot more sense in the long run. That ended up being a kind of a philosophical change. But in turn, I think probably the one of the bigger challenges that kind of bothered me was just kind of some of the baked-in costs. So, for example, they had a plan system called Map Navigator. It had access to 5 or 6 fund families, and ostensibly that was because these were like really high quality, well vetted, limited availability sorts of things. You had some big names like PIMCO in there, T. Rowe Price, MFS, and in that, you had some really competitive, really strong investment offerings, but you also had some very strange things. Like there was a T. Rowe Price S&P 500 index fund. Okay, S&P 500 index fund. What should that cost? 0.02, 0.03, 0.04%? It was like 24 basis points. And what I learned later is that was because essentially it was a product designed to be an index fund, but with higher baked-in costs that can then be used as part of revenue sharing agreements. So that's the sort of thing that sort of bothered me. It also bothered me that just as a firm, there were a lot of platform costs. If you didn't want to use these sort of house products, then, you could use this Map Navigator thing or this other advisory program, but you were going to have a, 0.15% or 0.25% just platform fee. And that ostensibly was to pay the operating costs of the brokerages and the underlying traders and the reporting and all of that. But that's really hard to justify when you had platforms like Charles Schwab, Fidelity, Vanguard, Robinhood, where essentially you can be on the platform for free and trade for free. Now, they make their money on payment for order flow and margin spreads and that sort of thing. But again, it was just very strange in hindsight looking at it and going, there's just a lot of costs here that really just exist to make money, not because there's a cost being incurred somewhere that needs to be covered.
Okay, that's fair. Yeah, I think as long as you don't materially cause anybody harm, that's probably the best answer you can give coming from an environment where there are products and different suites of services you can sell to people.
Well, and what about yourself? As you said, we both came from the fee-based world. So what did you run into that maybe by the power of hindsight you're not so, bullish on?
Yeah, I'd say to answer the question, right, we use the analogy of swimming a lot with clients, right? So somebody comes to us, they're financially swimming, meaning they won't drown. If they decide not to work with us, they hire us in large part because they want to swim competitively. I think there were instances at my old firm, and maybe this is me justifying it, where somebody came to us swimming and we got them to swim more competitively. But now, by the power of hindsight, I realize that we could have gotten them to swim even more competitively, right? So maybe we got their 100-meter and I don't know swim times from 25 seconds to 23. But now on the other side, I realized we could have gotten them from 25 to 21. And so I think that's a little bit of justification because there are people who are in better situations now than maybe they were before they came to us. But by the power of hindsight, there are some clients I think weren't great fits for some insurance or annuity products. Specifically, we liked to do or push a lot of in fixed indexed annuity products. And, this was at a time in which I kind of was still very early in my career. So I was as susceptible to marketing material and promotions as were some of these clients who maybe were ignorant and didn't know or work with financial professionals in the past, which makes it important just to kind of question everything, right? So like the why. And I remember there were specific times in which I got really frustrated with management because there were clients that said, look, I just want to make sure I can retire in a year to 3 years. And instead, we're just pushing promotional fixed indexed annuity products down their throat and trying to sell it as opposed to fix the actual problem that the client came to us for. And that was part of the reason for my departure over those 4 years, right? We got considerably more sales oriented as opposed to planning oriented. So I think some of those products definitely rub me the wrong way and probably now give me a bias toward not using them, even when there are times in which they might be an appropriate product for a client.
There's an old expression, right, which is that there are lies, damn lies, and statistics. And I think products like fixed index annuities, IULs, a lot of these very structured products are just perfect cases of that where, I know you talk to the wholesalers or the carrier reps, and they come in and they present this product. Here's the Allianz 222, or here's the Jackson National Perspective, or whatever it is. And you look at it and you hear the presentation, you hear the description and whatnot, and you sit through it, and like by the time they're done presenting it, you just sit there and go like, this is an incredible product. Like this thing can walk on water and can write a symphony all at the same time. Like what an incredible financial instrument. And then they just don't seem to survive contact with reality very well. And as you get to know them better, you realize like there's just so many terms and conditions that what they presented to you was, a true and genuine back test, but there's so many like but-fors and ifs built into that back test that just don't align to reality that it's really hard to look at any of those types of products now without a great deal of suspicion, because you're like, okay, I understand what you're telling me on paper and what you're telling me as like the presented benefits here, but I've seen so many gotchas and so many problems and so many mismatches with these products that even if I think I understand it, I worry, what don't I know about this? And if I don't really, truly, 100%, confidently believe I truly understand this thing, can I recommend it to somebody? Is it going to be in their best interest if at the end of the day I still have a doubt about my full understanding of the complications of this type of product?
Yeah, I think one of the realizations I came to, right, is the news flash for people is that the people who are rich and wealthy don't have access to these products that are magical and unique to people with higher net worths. So if you come into something that feels like that's what they're pushing, and maybe it's a little complex, you don't understand all the intricacies, and as you said, maybe it doesn't survive contact with reality, give it a second guess before you kind of dive into some of these things with 20 pages of disclosures and rules.
Oh, I mean, 20 pages of disclosures and rules even, undersells it. I got the prospectus book for a VA once. I think it was like 280 pages. And nobody's going to read it, right? You sign this paperwork that says you read all the terms and conditions, that you understand what you're buying. I don't think anybody's ever cracked the spine on one of those things, except to flip through it and go, holy crap, that's long. I mean, it's just amazing how much, of our industry hinges itself on disclosure and transparency. And the lawyers will say, like, well, it is written down and you can read it. And if you did read it, you would understand. And it's like, there's just no way. I have a PhD in personal financial planning. I don't think I can read the prospectus of an annuity front to back and be 100% confident that I understand that product. There's just almost no way.
No, I don't blame you, Dan. I've read some of those things, and half of it doesn't even feel like it's in the same language that we speak.
True enough. Well, that's enough of that. We can talk trash on bad products and confusing constructs all day long. So let's talk about something much more exciting and much more friendly to the everyday American: open enrollment.
For those that don't know, reading benefits packages is one of my hobbies and pastimes, especially this time of year. But open enrollment's a tricky one, Dan. We get 2 weeks to review this stuff, and I know a lot of people default to just auto-enrolling in whatever they had the year before, clicking yes, not actually reviewing the suite of benefits. What are some of the high-level items, maybe if someone doesn't want to read the whole packet, they can kind of control F into their PDF and see if they do or don't have access to?
Yeah, I mean, I think the best thing here, first and foremost, two very different camps of best practice. If you are, I'll just say, like a healthy, everyday person who doesn't have a very specific concern, as you go through your packets, look at your high deductible costs, right? Look at your out-of-pocket maximums. And sorry, I say high deductible costs, but just your deductible cost. Compare if you have a high deductible versus a non-high deductible plan, what the potential premium difference is. And this is a bit of a project, but honestly, I think one of the best things you can do is compare the cost of the premiums, just, hey, if I have to pay this for 12 months versus paying that for 12 months, and one of them is HSA eligible and one of them is not, and then you factor in funding the HSA and the tax savings from that, and then analyze that, like for every $100 you might have to spend on healthcare to see the break-even trajectory between those two plans. It's kind of tedious. It's a lot of work. So I know you said control Fing here, but sorry, like this is my actual answer for something health insurance. But I'm really understanding it because what we often tell clients is, hey, if you don't have any expectations of healthcare costs or any regular recurring expenses like chronic care issues or prescriptions, that sort of stuff, then you may just want to go with a high deductible plan because then you can use the HSA to get tax benefits. But if you have these chronic ongoing costs, you should go for more of a gold-plated ACA type plan to make sure that all your bases are covered and your out-of-pocket costs are as low as possible and so on. That's a very normal conversation for us to sort of have with clients, regardless of what's within their employer plan. It can then still be the case sometimes that sometimes the gold-plated plan still costs more when the expenses are too high versus the net tax savings of a high deductible plan and HSA. So I think, to your question, right, control F, go look at your deductible costs, go look at your out-of-pocket costs, go look at what your actual premiums are for you as an individual, you plus your spouse, you plus your kids, you plus your whole family, that sort of thing. I think the other thing to do in tandem with that then is that if you do have chronic care costs, right, you have a expensive prescription, you regularly need treatments for some condition, et cetera, really go and look at the summary of benefits document. You've seen it before, I guarantee. It's this giant, maybe 10, 12-page blue table, right? It's always sort of like blue and white as a table, and it starts with like the obvious stuff like your deductibles, and then you get down to page 7, and it's telling you like how much is going to be covered for maternity, how much is going to be covered if you have an inpatient hospital stay. Go try to find your specific concern or your chronic condition. Go try to find that specific detail and make sure that it is covered in a way that you need it to be covered. So that's sort of the deep dive element where if you have a non-specific needs, it's largely a financial question. If you have specific needs, then the finances probably don't matter as much as making sure that your specific need is taken care of.
Okay, so let's say I've done all that. Maybe I even did that last year because I work with you, Dan, and we did those tedious break-even analysis calculations and we're in the right plan. Can I just click yes next year? I mean, how often do these offerings actually change?
I think one of the clever tricks that gets played during open enrollment time is the urgency of open enrollment. So let me just give you like an employer side perspective on this. I got an email today at about 5 a.m. that said, we have all of your new benefits for 2026, for your review. Please review these and approve these no later than Sunday, November 9th. Okay. So today is Thursday. I'm being given 4 days by the brokers and by the carriers for the quotes they've given me to be good before they'll tell me, sorry, we got to reprice it and redo it again. I'm being given 4 days to do due diligence on all the insurance options available for myself, for my family, for my employees, for their families. Okay. So that's not unique to me. That's very normal. So you need to understand a couple of things here. Okay. Your employer typically is being rushed very quickly to just go ahead and accept things. They are often, and this is framing, right? They're often framed as just, here is your same policy as last year. Here's the slight difference in premiums, and there may be some changes underlying. You'll have to go look. Okay. And so in that timeline and the urgency, depending on what's going on, how busy we are, et cetera, we might just be like, well, if it's the same plan and all it is 6% more expensive this year, sure, so be it. Click, good to go, next. Okay. And then it shows up in your inbox and you get a week, 2 weeks at most to review and approve your elections. Okay. And at that point, we're really faced down with a situation here where it is very possible that your insurance policy has changed, right? Just because it has the same label on it does not mean that the terms and conditions are even remotely the same or identical. And this can even be the case where you had employer coverage and now you're going on to the individual marketplace, where I'll give you a good example. When I left IBM, I had what was called Kaiser's Gold HMO plan. And so I had that at IBM. I was like, cool. I went on the ACA marketplace here in Colorado. I found the Kaiser Gold HMO plan, signed up for it, said, great, same insurance. Went and did a checkup and some lab tests, 2-3 months after I got into that plan. And they said, great, this is going to be, $600. I'm like, what do you mean it's going to be $600? Like, well, you that's what your insurance requires. I'm like, no, I got these same tests done a year ago and it cost me $20 for the visit and nothing for the test. I said, well, you're on a different insurance plan. I'm like, I'm on the exact same insurance plan. Like, nope, just because it has the same name doesn't mean anything. So all that to say, right? You can't take it for granted year over year. You do actually have to go look at it every single year and assess its coverages and what it actually provides every single year, because from a legal and technical standpoint, it is a brand new insurance policy with brand new terms and conditions.
All right, there you have it. Got to review every single year. So here's another tricky part of open enrollment, Dan, right? I'm married, and me and my spouse have different periods for open enrollment. So if I'm reviewing my suite of benefits, but my open enrollment period is 2 weeks before my spouse's, how am I really going to compare apples to apples to see what's best for me?
So that's a challenging one. You sort of have to just use the best information available to you, because, much as you might want to say like, well, hey, spouse, go to your HR department and ask them what the benefits are going to be next year. Remember what I just said a minute ago. They probably have no idea. So you really just need to kind of do this overlapping approach where you say, okay, based on the coverage I have available to me right now and that you have available to you right now, let's just pick the optimal mix of coverage for ourselves. And then when we get to your next open enrollment, we're going to do the same process. So, maybe their enrollment is in June, your enrollment is in November. It just means we're reassessing our insurance coverage and our insurance needs essentially, every 5-6 months instead of assessing it once a year. We just want to try to go ahead and use the best information available to us at the time. Now, the nice thing is, if we lose coverage, let's say, an employer says, sorry, we're not going to offer health insurance anymore. It got too expensive, because let me tell you, it's getting expensive. In that situation, that creates a special enrollment period that should make your spouse or you, whoever lost their coverage, eligible to join your plan, because there's been a material change in circumstances, or they can't join your plan, then they would still be eligible to at least get their own individual coverage at the healthcare exchanges.
Yeah, I mean, this is one that just frustrates me. It doesn't feel, maybe fair is not the right word, but I just don't love that it's not a uniform period of time for everybody, so that we can't really just compare apples to apples. Maybe one day.
Well, and I'll tell you how this happens, just because I think sometimes people are like, why would you have it in April? Essentially, your enrollment period is established based on when you establish benefits. So like when I first, took My Wealth Planners Independent, and we had Samantha as the first associate planner here, her, start date was June 1st of 2021. And so, circa like May, I had to go and talk to the brokers and be like, great, I want to get like group health and life and all this stuff put in place, because it's going to be more than just me now. And so they set it all up. And when they set it all up and set up all the quotes and whatnot, they set the eligibility and the enrollment dates on essentially June 1st. And boom, June became our enrollment period. And then it took me essentially 3 years to get it like forcibly adjusted to a more traditional like November enrollment for effective dates in January period. And I'll tell you, they fought the hell out of me on it. Like I tried to get it done for the first 2 years, and they essentially told me 2 different versions of a story, right? The first year, they're like, sorry, it's impossible to change. The second year, they said, oh, we could change it, but you really needed to ask us like 4 months ago. So then like I had like a pin in the calendar the year following where I was talking to them like 5 months in advance to get it changed. And even then they were trying to talk me out of it. It's like it's just, there's sort of this institutional resistance to moving those dates around. Now, I'll say to any business owners out there, be a mensch, be super nice to everybody, and just put through the work to try to get your enrollment period shifted over to a November open enrollment period for benefits starting in January. If every employer could do that in the United States, that would just be great for the employees. And I'm sure for you, even you yourself, right, you and your spouse, whoever you are out there, probably be great for you too.
It's good advice. I've read 100 of these before. I know you have. What are some maybe hidden gems that aren't, typical during open enrollment that you see as like a offering for a benefit?
I've seen some really neat stuff out there, actually. You don't see these in small employer plans as much, and I think it's just because the economy of scale isn't there. But a lot of big employers offer what are called employee assistance programs, and it's sort of a catch-all term for just like a catalog of kind of just extras. So I've seen everything from like estate planning benefits, where you can just like get a will and trust done by a licensed attorney through the company. I've seen benefits where you can get, mental health care, drug and substance addiction stuff, treatment. I've seen stuff for like child trauma. I saw a thing where there was even like a healthcare concierge where like somebody would handle scheduling your appointments and like working through the logistics. There are some really neat novel things that can be embedded in benefits programs. So it's something where, most of us kind of just default to like the health insurance, life, vision, dental, disability, 401k enrollment and call it a day. But I actually think it's really meaningful and really special to kind of try to dig through, particularly if you're with a larger employer. I'll give you an example. Like Apple's enrollment benefit package is like 394 pages long. Like their HR document is enormous, in part because they wrote it like a user manual in like the best possible way. Like they have like 90 pages on their RSU system and like how to do an 80 lecture and everything. It's actually incredible. But like buried all the way in the back pages, there's this whole section of catalog benefits for like counseling, mental health services, all sorts of stuff. So I just share in general that like there can be some really neat stuff embedded in your benefits package if you take the time to go look for it.
All right, cool. Hey, if someone needs their benefit package read, bring it over here. I think I read Apple's this week, and I think it was 464 PDF pages.
Yeah, sounds about right.
All right, well, let's wrap it up here, Dan. Let's get pretty technical. The timing of Roth conversions. So it's the end of the year. So a little bit of a spoiler. This is when we typically will initiate and discuss Roth conversions in Q4 with our clients. But I think there's an argument to be made for doing it during other periods in the year, right? So I think there's 3 ways we can break this down. But for those that don't know, right, high level here, a Roth conversion is essentially the process of taking funds in a pre-tax setting like a 401k, a traditional IRA, then converting them to a Roth IRA with the intention of paying the tax in the calendar year at hypothetically lower tax rates than we likely would in the future. And there's ancillary discussions that can be had here around, multi-generational wealth transfer and the ease of doing so when it's after tax or Roth versus pre-tax. But that's the high-level version, right? I want to break this down into 3 schools of thought here, Dan. 1, we convert in the beginning of the year. 2, we break the conversion up throughout the year. And 3, we make the conversion at the end of the year. So let's talk about, the benefits and downsides to each. Feel free to start where you want here.
I'll even add one more on here, which is just, I'll call it like tactical timing conversions, maybe special events driven. So we'll touch on that too. I think what I'm going to describe here is that all of these are valid strategies and they all just have the different pros and cons. There's no right or wrong answer here. It's just what benefit do you want to kind of do it for and what risks are you willing to accept? So if we do a beginning of the year conversion, then the benefit is hypothetically, law of large numbers, we should expect, generally speaking, that the value of our assets will increase this year. Doesn't happen every year, but that's the basic assumption. So from that presupposition, then, if we do our conversion earlier in the year, then we are getting converted at the beginning of the year, and then good news, the market goes up, and that gives us 2 benefits. 1, that money is now growing tax-free. And 2, we don't have that much more in pre-tax assets that we have to convert later. So that's the positive side. The potential risk here is we don't have a lot of data about our tax situation for the year. Stuff could happen, right? We could sell property, we could realize capital gains, we could get dividends or interest. All sorts of things could potentially bump our income up in unexpected ways that result in us then accidentally being pushed into a higher tax bracket than we thought we would, or being pushed above certain IRMAA surcharge thresholds for people on Medicare, resulting in higher Medicare costs. So that's the risk that we take with early year conversions. The back end of year conversions essentially reverses this formula. We accept the risk that the market could go up or down, right? Or that, as a result of it's gone down, that maybe we've lost out on some potential value, although maybe now we can convert more because the market's down. But conversely, maybe there was a better time to do it this year for whatever reason. On the other side of this, we now have much better data about our tax situation for the year because we have had most of the year pass, right? If we're doing this in, let's say, November or December, right, we've had most of our income recognized, most of our interest earned, most of our income generated, most of our capital gains realized, so on and so forth. And we are probably close enough to the end of the year now where we can forecast with greater accuracy what's likely to happen in the next 30 to 45 days. And so the risk that we blow through tax brackets or go over IRMAA limits and so on is substantially reduced. So that's the pro and con of kind of the beginning versus the end mode. Spreading it out throughout the year is a nice dollar cost averaging sort of strategy. My hesitation with this is I don't know that it really solves either problem. I think it just sort of gives you a suboptimal kind of best of both worlds version where, we're converting earlier in the year, maybe the market's going up or the market's going down, and that's benefiting us somewhat. I think that you kind of get a little bit of all the benefits in that, but they're just not the best version of that. I think the con here is actually just execution. Most brokerage platforms are not set up in a way to make Roth conversions super easy or super easy to systematize. And so the issue that can arise here is that it becomes a manual process, and manual processes are more likely to break down due to distraction, forgetting, scheduling issues, sickness, vacation, or emotional decision making, right? If you have to kind of go in and manually type it in and plug it in every single time you want to do it, and you're doing this every single month, are you responding to current events? Are you starting to think like, gosh, maybe now is a good time or now is a bad time? Okay. And so then that gets us to the fourth one that I inserted, which is the tactical version. And the issue with the tactical version is just going to be this. You're waiting for something bad to happen, right? Some drop in the market, some drawdown, some bear market or something to happen, so that then you can do a conversion based on lower asset values, okay? Which means you're going to spend all year eyeballing the market, which is going to probably increase your level of financial elation or anxiety just day to day, as watching the market tends to do. And then you're trying to time the market, same as buying or selling. And as we know, timing the market tends to be a not terribly productive activity. So in that particular regard, I just don't recommend tactical conversions unless the opportunity is substantial and significant, just because fundamentally, you're trying to time the market. And as we know, timing the market just doesn't work that well. There can also just be issues here with converting assets versus converting cash and the potential changes in value if the market's very volatile.
All right. Well, is there a scenario maybe on behalf of clients we can have our cake and eat it too? So we do end of the year conversions, but keep in mind that if the market maybe drops a certain percentage or below a threshold that we're keeping an eye out for, we might do a partial or the full conversion earlier in the year.
Yeah, I mean, we're saying, hey, right now, all our forecasts and expectations say you're going to be in the very low, 12% bracket or 22% bracket. So we feel pretty comfortable converting, 10, 20,000 now and then sitting on it for the rest of the year. I think that's fine as long as we have high confidence, right? We haven't seen a lot of variability. We're not expecting to inherit any stuff or sell any property, that sort of thing. The one challenge here that I find is that people are very forgetful. Like I've had a full Roth conversion conversation with somebody at the end of the year, right? And it's like started to get all the paperwork in line to get it done. And like a day before we did it, somebody else just like reminded the client that they had sold something for like a $15,000 gain. They're like, oh yeah, does that make a difference? I'm like, yes, it makes this a terrible idea. I'm just a little bit hesitant about breaking it up. That's not a perfect system. But again, there can be reasons to go ahead and try to hedge it a little bit. I think this gets back into the dollar cost averaging version of the thing, which is, hey, if you break it up, you're just getting the suboptimal version of both sides of doing it early versus doing it late. So it's not really any different than that. It's just the question of frequency.
Yeah. All right. That makes a ton of sense to me. I don't really have a ton of questions here. I think my advice would just be pick one and stick to it. But I think that really helps there. Appreciate it.
Well, that's an easy question when you think about it all the time.
It's fair enough.
But that means, since we're done with your questions, it's time for my question. So what is it, Daniel, that you've learned in the last week that you think our audience would benefit from?
Well, since we're on the conversation of Roth conversions, right, this is typically something we see with people maybe on a sabbatical, or they have a low income year, or they're more likely than not in retirement or nearing retirement. So we're having the conversation, which kind of just like, I don't know, I see some folks recently, right? We have clients with objectively what I'd consider to be very high net worths. We have some that maybe wouldn't consider themselves high net worth and are lower net worth, and a lot in between. There's not a direct correlation between higher net worth and more enjoyment in retirement or going to retirement. And I think when people are retiring, one of the things they want to ask themselves and just have a good understanding of, especially those that are considering, a non-traditional retirement, so like pre-65, right? Is it a push or a pull? Are you being pushed out of your current career or job because you don't understand or, the changes, or you're no longer interested or are burnt out? In which case, maybe just a job shift or finding a new career or something less stressful is honestly a better use of your time? Or are you being pulled and drawn towards something? Is there an interest or a hobby or passion that now that you have the financial means, you want to pursue. I think the latter tends to lead to more fulfillment, right? We're being pulled towards something we enjoy and love doing. Some of our clients that are objectively wealthy and wouldn't consider themselves enjoying retirement as much as maybe they thought they would, there's a reason for it. It's because they really didn't take the time or haven't found something to retire to. They retired out of something. They left the job they didn't like, or they just escaped. And, that can feel great for a period of time, right? Wow, I got out of that job. I don't have to deal with my boss. This is great. But that fades pretty quickly, right? And that can last 6 years or 6 months to a year, and you have that honeymoon phase. But once that ends, you need to find something. And I mean, I can talk about this all day. I don't think travel in and of itself for even 4 of 52 weeks is that thing. I think you really need to find, are you retiring to get away from something, or is there really something you want to retire to?
No, I think it's a really good observation. I know we tend to recommend quite often that people do a sort of trial retirement before they retire, right? Take 2 weeks off, a month off, and don't do anything, right? Like don't travel, don't go somewhere, don't have like big plans, but just like hang out, kill 2 weeks or a month reading, watching football, playing golf, whatever it is that you would do more day to day over the course of a year versus big exciting trip to Italy or something like that. It's remarkable how fast you can get bored when you really don't have that thing that's pulling you to retirement versus pushing you to retirement.
Funny enough, too, it's remarkable how quickly you can get bored. The beaches and cocktails get old quicker than you might think for a lot of people.
Oh, I'll take that challenge.
Fair enough, Dan.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.